Good day, fellow investors. I want to go through some comments on my videos because one is discussing just the data. One is digging into the personal situation strategy that's only reflected in the comments. And this video will be based on your comments, but on the topic of price or strategy-driven situations. And we'll also finish with a great quiz that will put a lot of things in perspective. And let's immediately start here with this comment. So, the narrative, why do markets crash? Okay, short term they can crash, however, eventually the markets come back. Okay, and then the key crucial there, high valuations, yes, but AI is not a bubble, it's an industrial revolution, and there will be huge return on investment capital over time, and that justifies the valuations. As Benjamin Graham said, the market is a voting machine, voting for this now, and a weighing machine in the long term when it will weigh whether it was right in the voting now. So when it comes to investing, short term is driven by sentiment and flows. Long term, long term, it is at the end valuation. And what is pushing the current market higher? We have ETF inflows, buybacks, foreign inflows, but everything is priced to perfection. And this is something that pushed the market higher over the last decades because more and more global money, European pension funds, followed into US assets. And now more than 20 trillion, which is 1/3 of the US market, is owned by foreigners. The rest of the world, we have 10 billion, a little bit more, and Europe another 10 trillion. And if ever all those foreigners decide, okay, it's time to turn a little bit because of valuation, because of this, because of that, that 20 trillion going down to just 15 trillion, taking 5 trillion out, that would push the market down 30-40% like that. And then you say, yes, short term, the Fed would intervene. Politically, the Fed intervening to give money to foreigners selling is a tricky political question. But okay, this is what's now pushing the market, 1.4 trillions in ETF flows, positive globally, whatever. And the fact is that prices are going up, but as we discussed last week in the Mag 7 video, we don't yet know about the returns. We know now that the costs, the depreciation, will lower net incomes over time. And here value investing comes. I'm not betting my future wealth on something that might or might not happen. Maybe if you have a few thousand, then you don't care. If you lose, okay. If you don't lose, great. If I'm looking at my wealth, at my long-term retirement, at my long-term financial safety, most people are. I'm not betting it on a bet that a P ratio of 31 will give me or return on AI or chips in space or things like that. That's the key difference here between price and valuation. And the P ratio that you can check in the link on the description below of my portfolio is still just 10 compared to the market's 30. And then we can discuss gold, a lot of discussions there. If you're certain that gold will hit 10K, and that you can do better. I didn't say when will gold hit 10K. Everything is working for gold. Inflation, momentum, purchasing, lower, let's say, love for the dollar and things like that. But there is the long-term inflation protection. Over the next 10-20 years, it will hit 10K. It might hit it in 2 years, okay, but it's too risky to expect that return in price. And I have things that will give me better, hopefully, than 10% down the road. As we have been doing 15-16% for the past 8 years. That's something on low valuations. And then I said to my friend to sell at 5,000 to switch to a fundamental strategy. And that's why we sold the gold, not because of price. Yes, it might be at 8,000, it might be at 4,000, but that's not sustainable long-term investing, in my opinion. A great comment here. Fabio from Italy has 30% gold, 20% silver, and other investments generating cash flows, 30% cash, 10% other. And now the question is, how good is this strategy? It is a strategy, likely protection from inflation, but the question is, do we have better? For 50% gold and silver is, in my opinion, risky because yes, you gain the momentum of the recent bull market, but it's also not producing anything. But as Dennis here says, I will keep my goal. That's something that I understand. That's also crucial. That's also key. You do what fits you best. Investing is personal at the end. But also the comment above, there will be inflation. There is no way out around the debt piles, the this, the that. Therefore, gold over time will do well. The question is, what kind of risk, what kind of volatility can you expect or not? Price versus fundamentals. I sleep better on fundamentals. And then the favorite comments there, this guy's changed his opinion every 5 minutes, or I'm certain I can predict, then I don't know where gold will go. I have no idea where gold will be in the next 5 years. Over the next 20, I know it will likely be higher. That's about it. Where the range of expectation could be very wide, could be 2% per year, could be 20, you never know depending on what happens. But I want to have that range of expectations between, let's say, 8, if I'm wrong, and 20. That gives me more certainty when building wealth long term, not betting. As Theodore says, well, the strategy works and it is a great strategy. That's what works for me. What's the point of watching my videos? And this is the key problem in this market. 99% of the population is focused just on price. Buybacks, managements, buy, no matter what, let me push the price higher, sell, buy the villa, the Ferrari, nobody cares. And then I come here and we discuss fundamentals. That's the freaking message. And I know it's hard for most people to understand because it's just so easy to just superficially look at price and who cares. And that price, look at price, has worked over the last 15 years, especially for Tesla investors. Now perhaps the Bitcoins are not that great anymore, but that also shows what happens when you look at price. When the focus is only on price, when something crashes, what's left if you have no fundamentals? Nothing. And that's the message I always try to share. And then, okay, then you say, but Sven, should we have 5% in Bitcoin, 10% in gold, diversification? And then the question is, what's the cost of that diversification? If I have 20% in gold from 2012 to 2022, I made nothing on that 20%. I made 5x on my portfolio in those 10 years. Thus the cost is not 20% no returns, the cost is a 2x of your portfolio. That's the key question. If you have fundamentals, you slowly build with more certainty. Maybe there will be a lost decade for stocks. I never said I'm investing in stocks. I'm investing in businesses, a few specific businesses that I can find at the right price. But let's discuss strategy and scenarios. Gold, it can go to 10K, it can be 50% down in 10 years. If we just look here, it was down more than 50% over 20 years. Here it was down over almost a decade. We'll see where it goes from here. Ups and downs. Definitely protects from inflation, but it is driven by sentiment. What happens to you 20 or 10 years of nothing or down 50%? Maybe you can tolerate the last crash of, what was it, 10-15% over a few days, and then it will rebound. But the real capitulation, and we are seeing it with Bitcoin, starts when the crash lasts longer, 6 months, 6 years. Then you start really changing your mind, and that is where you get affected from non-producing assets. I would prefer to own a farm. You have a yield, you have land, you're protected from inflation, and as they say here, actually my cows are more valuable than treasuries. They produce organic fertilizer I can use to grow things, reproduce, I can eat the offspring, better than being eaten by the government. That's the key. Of course, you need to work a little bit, but it is big difference. The question here on debt, debt crisis. We cannot know when it will happen, we just know that it will likely push inflation higher. So we need to have a strategy that will work no matter what. Gold will work only in one situation: the debt crisis, the money printing, the zero interest rates. All was a great story exactly in 2012. Then it didn't happen. Now we have same expectations with gold prices higher, so it might happen, it might not happen. That's the problem. So when it comes to value investing, margin of safety, pricing power of the business, compounding, reinvestment, long-term return on equity, currency, irrelevant, you're owning the business. Whatever happens to the currencies, you're okay. Recession, debt, irrelevant. Even in recession, Berkshire would give it an opportunity to buy assets lower. Sentiment, usually long-term irrelevant, but if you can buy cheaper, perfect. Accumulate wealth that will produce value for people over the long term. Don't bet on prices. And now, the quiz. If you're focusing on price or not, what is the owner's earnings yield of your portfolio now? If you don't know, click immediately on the don't know. Is it 3% to 5% like the market, 5 to 8%, or 8% of higher? I'm looking forward to your answers, and we'll discuss that into the next comments video. Hope you enjoyed, check my research platform, and I'll see you in the next video.